Hey there, everyone. I know a few of you have been asking for these chat rundown videos again, so here's a quick one to start the week. Excuse the voice, something respiratory going around here. I shared a few quotes in chat to start. Life can only be understood backwards, but it must be lived forwards. Kierkegaard. That kind of goes along the lines of hindsight capital we were talking about, where sometimes I don't know if you can relate. I'm very hard on myself for my losers. Recently in Q4, we had those clinical stage losses in Cura Oncology, T-Scan Therapeutics, TCRX, Repair Therapeutics, RPTX, and Ematics, which I all sold in favor of increasing the commercial component of the portfolio. My loss in Cura, I can say maybe that was due to the competitive landscape. They ended up taking a deal that was, I thought they gave way too much economics up for too little with the Kiowa Curran deal, but definitely got blindsided by that. T-Scan Therapeutics and Repair, I definitely Repair when the CEO, here you can see it gap down from 4 to all the way down to 1 on the well, gap down to mid twos and then eventually bled down to mid ones on the readout. The CEO had compared their opportunity for camonsertib, lumasertib combination to an Elahere type opportunity in endometrial and ovarian cancer. So definitely a case of cheerleading, and I got sucked in there. They have more catalysts next year, but I ended up not wanting to hold on for that. They met their bar for ORR, but not for the durability and other aspects, which disappointed. So a key takeaway for me in the portfolio going forward is focusing on those bread and butter positions, commercial stage, especially launch plays that have been working out so well for us. Trying to keep that percentage of the portfolio at 70 or higher, 70%. So yeah, looking forward doing the best we can in a tough environment. It's not fun to have your year to date gain to give gains back to the market. In my case, I was up over 40% for this year, which is good considering how tough it was, and XBI has been pretty flat, and that got cut in half now to 21%. So I mean, I still met my goal of not giving gains back to the market from last year after we had a pretty hot streak, but still that's disappointing to give that much back to the market. Another quote I shared was this: never forget the value of being the last man standing, Fred Martin. Again, the idea being constructing a resilient portfolio, especially with biotech, something that's going to withstand whether it's inflation or whether it's these other concerns, lack of M&A activity, etc., clinical blowups, or when you are exposed to these speculative companies, if that's your thing, keeping position sizes to a level that if something blows up, you'll live and fight to fight another day. So that's something that's been huge the last couple of years for me is making sure that it's positions that I travel a lot. People see I've been in Colombia, Medellin, Panama, Mexico lately. If I were in a place where I can't look at my computer screen or phone screen for months on end, you want to be in companies where you have a decent idea that heads you win big if things go your way with the thesis, and tails the loss, the downside cushion there is limited. You'll be all right. Situations with as much evidence as possible of strengthening thesis. I wasn't going to add another quote, but this last one to start the day was pretty nice. It is remarkable how much long term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Charlie Munger. So, again, I think a lot of my errors, you can see my winners losers post under the resource section in ROTY. Previous winners and losers. So you have some winners at the top, the charts, what I learned from them, and some of my more binary losers here at the bottom. And a lot of these losers could have been avoided simply by not trying to be the smart guy in the room. There's so many setups up there that are, just like our recent commercial stage entries. I talked about SpringWorks Therapeutics selling at about one times peak sales for the Ogsiveo and Desmoid plus their mirdametinib and NF1PN. So situations like that where heads it could go your way and you're looking at a double or more, and tails you're looking at pretty de-risked. I don't want to say obviously it's biotech, anything can happen, but a significant amount of downside cushion where if there's regulatory delays or whatnot, you'll still be okay. The loss will be hopefully limited to a reasonable number. So my point being, why would I not go for a much more de-risk setup like this as opposed to going for repair or going for these other clinical stage companies where if I get it right, great, looking at a multi-bagger, and if I get it wrong, the market's been punishing these companies lately. Even if data is decent, it's still a gap down 30%. And if data is truly bad, that's when you're looking at a total loss of capital, right? So again, I'd rather prioritize these situations, these setups where we have as many factors in our favor as possible, and we're not, you know, we're trying to make the portfolio as resilient as possible. So yeah, that's again why I'm staying away from speculative names for the most part. And when I am in clinical stage land, something like Regenix Bio, currently at after this decline, $100 million of enterprise value. That's backed up by their MPS 2 program alone with the NDA submission in Q1. And let's call that a 300 million peak sales just on the conservative side. So it's nice that you have the company undervalued on that alone. Plus, you have their DMD program where they're trying to differentiate on safety and perhaps better functional outcomes versus Sarepta. Then you have their eye programs partnered with AbbVie. They might be getting a $200 million milestone first half of next year for their diabetic retinopathy phase 3 starting. So, situations like that where just as much de-risking and downside cushion as possible. Going to a question in chat from Eric. He asked, TARS, is there a price target even for buyout? Should I add more or reduce the size? What do you think? So looking at the chart here, you can see TARS has done pretty well for us. One of our bread and butter launch ideas got in when people thought XDMV wouldn't do well. Demodex blepharitis, those collarettes in your eyes. People, mites basically. People thought that wouldn't be a big thing, especially when there's off-label treatments that aren't perfect, but at least they're pretty decent. And ended up not being the case. You're looking at a billion or more of peak sales potential. So my response to Eric was, hey, I already have, after partial profits multiple times, I still have 144% gain, 8% portfolio weighting. So, if enterprise value went up to maybe 3 or 4 times peak sales, I would probably go ahead and take partial profits again or sell the position. I don't do price targets unlike others, bloggers, writers, analysts out there. I tried to do them in the past, but they weren't for me. They didn't add value for my process. In chat, people would always get confused when let's say a stock is at $10 and the story doesn't work out, or there's new evidence, new news I don't like, and I sell it. And they say, hey, you had a $20 or $30 price target on this. Why did you sell? And so, people sometimes get confused. That's the bull scenario, but obviously there's a myriad of scenarios. Price targets are meant to be useful in where the stock could go, but not necessarily predicting the outcome. So in this case, TARS is at 53. Let's say it goes up to the $70 range. I could see myself taking partial profits or even exiting. Again, for me, it's more about looking at the present snapshot of risk and reward. And if it's favorable, I'll keep holding patiently, that high upside. And, if I'm looking at the stock at $70 and I'm thinking this risk reward here, there's more ways I could get hurt. There's more of the blue sky scenario priced in. Maybe it's time for me to exit and move into something that's much more appealing risk reward wise. So again, that's how I look at it. Last week, I had a friend pitch me PureTech, PRTC, and then Michael in chat pointed it out as well. Company has 400 million in cash, as he points out, market cap of 500 million, so looking pretty cheap. They got rights for milestones and royalties for Cobenfy. Karuna was acquired by Bristol Myers. That was their new MOA for schizophrenia. Hub and spoke model, so they have multiple companies under the umbrella. Their recent IPF data for LYT-100, a deuterated form of approved drug, pirfenidone, I believe, looked pretty interesting. My pushback on there was it looks pretty undervalued, but what is the catalyst to drive it higher? In my case, you guys know I need this accelerating, whether it's commercial momentum, clinical momentum, to keep me interested. So definitely an idea worth looking into at some point. As an aside, I'm currently doing an article, company specific write up. I haven't done one of those in a while on Aquestive Therapeutics with Anafilm for anaphylactic shock or etc. That sublingual oral film technology they have that's pretty unique versus the approved, EpiPen injectables or the what was the nasal one that was approved recently, Neffy. Market cap pretty cheap at 330 million. It's not a stock I'm considering, at least right now, for the portfolio, just because if they do their NDA submission in Q1, that won't even get approved until maybe late 2025 or so, or even early 2026. So those, you guys know I'm not a fan of those catalyst deserts. They also have a topical gel for using epinephrine. They're going to start with alopecia areata, and that would serve as proof of concept to, pipeline in a product, address other skin conditions. So really high upside here. Maybe some of you would like this as a long-term idea, taking advantage of the weakness. So for me, yeah, hopefully in the next week or two, I'll have an article out on that, and just to have that for us to refer to later on if and when this one does meet selection criteria. ADAP, TCR, therapeutics type idea, platform technology play, very, very out of favor. Probably, looks like it's going to keep reverse splitting or out of burn cash out of existence. Reason I bring it up is TDM Invest in our chat. You guys know he does unloved commercial ideas, and seems like a lot of the ideas that he shares in chat, where for me it's not for me, and then it ends up doing pretty well. He's had a hot streak of late. So with the usual caveats, he brings that one up here and talks about how the cash, they have cash of 186 million, long-term debt at 50 million, dosed their first patient. I believe it's approved in sarcoma. They're looking at cost cutting to 300 million over the next few years. Management is saying pathway to break even in 2027. Even with Humacyte, which is Huma, recently had their drug Symvess approved. They're developing essentially parts for humans. This was a bioengineered vessel for extremity arterial injury. The differentiation there showing including what was it, lower infection rates, better outcomes, etc. It looks pretty interesting, but I remember from management commentary they said it would take 6 weeks or so from approval before they ship their first product. So I could be missing out here too, but as you guys know, I would prefer waiting for the first quarter of two of launch and getting some metrics to go by to gauge demand. I know there's a lot of cheap alternatives out there, competitive landscape wise. Maybe after my article on Aquesttive, this is one that I could dig deeper into for you all as well. So yeah, I'll rest the voice there, get back to looking at morning news flow, and as usual, looking at news, charts, etc., new ideas on radar, and catch you all in chat. Cheers.